Everybody is betting big on artificial intelligence. I mean, we are talking about investments so huge they could literally reshape the entire global economy. But, while all the headlines are screaming about breakthroughs and massive deals, there's this sophisticated financial instrument that's quietly flashing a huge warning sign. So today, we're going to pull back that curtain, figure out what it is, and what it's telling us about the future of AI. Let's get right into it.
$300 billion. That's the rumored value of Oracle's cloud deal with OpenAI. It is an absolutely staggering figure. It's one of the biggest bets ever placed on the future of artificial intelligence. And to pull this off, Oracle is basically building a digital empire of data centers from the ground up.
And how are they funding this empire? Well, with debt, a lot of it. Oracle has taken on over $126 billion in new debt to fuel this AI infrastructure build-out. Look, it's a classic high-risk, high-reward move. If this whole AI boom keeps going, they're going to win big. But if it stumbles, that mountain of debt becomes a very, very serious problem.
Which brings us to the big mystery here. With all this optimism, all this money pouring into AI, why are some of the smartest traders on Wall Street using this really complex financial tool to bet against companies like Oracle? What in the world did they see that maybe the rest of us are missing?
Well, the answer lies in a financial instrument that has a pretty notorious reputation. It actually played a starring role in the last global meltdown. I'm talking about the credit default swap, or CDS. To really understand the warning sign, we have to first understand the tool itself. So, what on earth is a credit default swap? At its heart, it's actually way simpler than it sounds. Imagine you lend a friend some money. You might be a little worried they won't pay you back, right? Now, what if I came along and said, hey, pay me a small fee every month, and if your friend ghosts you, I'll pay you back what they owed you? That's a CDS. The buyer pays a premium for protection against a credit event, like a bankruptcy, and the seller provides that protection for a fee. It's literally an insurance policy on debt.
Okay, so you've got two players in this game making opposite bets. First, there's the protection buyer. They're paying that premium, which is called the spread. They are basically betting that the company is going to get into trouble. They are short the credit. If the company defaults, boom, they get a big payout. On the flip side, you have the protection seller. They're collecting all those premium payments. They're betting the company will be just fine. They are long the credit. And here's how it all plays out, step by step. 1, the buyer starts paying those regular premiums to the seller. 2, the seller is now on the hook, agreeing to cover the loss if something goes wrong. 3, a trigger happens, what's called a credit event. Usually that means bankruptcy, or the company just fails to pay its bills. And finally, step 4, the seller has to pay up, covering the buyer's loss. It's a clean, simple transfer of risk. Okay, let's bring this all back to Oracle. This chart shows you the cost to insure Oracle's debt for 5 years. It's measured in something called basis points, or BPS. Don't worry, a basis point is just 1/100%. So back in 2021, it cost a measly 45 basis points. But just look at what happened in late 2025. It shot up to 102, then 110 basis points. That's the highest it's been since 2009. The cost to insure Oracle's debt more than doubled. That is the market telling you loud and clear that it sees a lot more risk. Now, a spike in CDS activity on one company is, well, it's interesting. But it becomes downright alarming when you remember the last time these things were on center stage. The 2008 global financial crisis. They didn't cause the crisis, but they were like pouring gasoline on the fire. See, back in 2008, the market was flooded with these things called asset-backed securities. And a big old slice of that pie, about 14%, was made up of something called ABS CDOs. These were these super complex financial cocktails, all mixed together with different kinds of debt. And hidden deep inside a lot of them were those infamous subprime mortgages. And you don't have to take my word for it. The financial expert Jeffrey T. Prince summed it up perfectly. He said, they are complex, few investors understand them, and they are widely blamed for the housing bubble and subsequent financial crisis. They were basically ticking time bombs that almost nobody really understood. So the real problem was how the risk got so buried in the first place. You had this originate to distribute model. A homeowner gets a mortgage from a local broker. That broker sells it to a small bank. That bank bundles it with other mortgages and sells it to a huge investment bank. The investment bank packages it all up into a CDO and sells it to a pension fund in another country. In that long, long chain, accountability just vanished. The person who made the loan in the first place had zero incentive to make sure it was a good one. And the consequences?
They were absolutely catastrophic. Just look at the ABS CDOs that were created in only 2 years, 2006 and 2007. Of the $330 billion issued, over $233 billion of them defaulted. That is an insane 71% failure rate. The hidden risk became a very real, system-collapsing loss. Okay, so thankfully, the market did learn some hard lessons. After the crisis, everyone got together and created what they called the Big Bang Protocol. They standardized the contracts, so instead of this messy process of physically delivering bonds when something defaulted, they created a much cleaner cash settlement system using auctions. It took a lot of the chaos out of the system, but it didn't get rid of the risk completely. Which brings us right back to today. Because while the CDS market is definitely safer, a new, massive, and kind of murky area of finance has exploded. And, well, it shares some really troubling similarities with how things looked right before 2008. So, welcome to the world of private debt. Right now, the private debt market is worth over 1.7 times trillion dollars, and it's growing like crazy. This is where companies that can't or maybe just don't want to borrow from regular banks go to get loans. It's a really important part of our economy, but it pretty much operates in the shadows. And inside these shadows, we're seeing some very familiar risks. Get this, 70% of these loan portfolios aren't marked to market, which just means nobody knows their true value is just an estimate. They're illiquid, so you can't just sell them in a panic. And here's the scary part. Huge institutions like pension funds are heavily invested. Opaque valuations, illiquid assets, interconnected risk. Sound familiar? It should. It's the same playbook from 2008. And this is where the parallel becomes impossible to ignore. In 2008, the toxic asset was risky home loans bundled into opaque products called CDOs. Today, the concern is risky corporate loans, a lot of them from that private debt market, being bundled into opaque products called CLOs, collateralized loan obligations. It's eerily similar. Okay, so let's tie all of this together. We've got the tool, the CDS, we've got the history lesson from 2008, and we have this new massive market of private debt. So how does this all connect back to Oracle and the big AI boom? Here's the key. The traders buying protection on Oracle aren't necessarily convinced that Oracle itself is going to go bankrupt. No, they're using Oracle's CDS as a proxy, as a hedge against a downturn in the entire AI sector. Think about it. If the AI hype bubble were to pop, companies like Oracle, the ones with these huge mountains of debt, they'd be the most vulnerable. So insuring Oracle's debt is a clever way to insure against a massive AI credit crisis. And that really brings us to the main takeaway. For all their complexity and their dark history, credit default swaps serve a really vital purpose. They're like a sensitive barometer for risk. That rising cost to insure debt, that's the canary in the coal mine for the financial system. It reflects the market's hidden fears and anxieties, pricing them in long before you ever read about them on the front page. So that leaves us with one final, pretty provocative question. Is this tool, this thing that can signal danger so clearly, also the very instrument that could pour gasoline on the next crisis? Are credit default swaps a vital early warning system we should all be watching? Or are they the fuse just waiting for a spark to light the next financial fire? That's a question the entire global economy might have to answer, and soon.